Welcome everyone to US Taxes for Expats. Our tax expert accountant answers your questions for 2024-2025. I'm America Josh, and welcome and thank you for joining us. We run this webinar every single year, and we know that new people arrive into the United States every single year. So we know that there are always new bits of information that people want to find out. People want to refresh their minds about how the tax system works in the US. And then we have a lot of new arrivals to the US and a lot of new arrivals to our community. And we welcome all of you and thank you for joining us tonight. We want to put together something where it explains not only the fundamentals of what's different, but also gives you some questions to ask. So when you talk to your accountant, whether that be Jason or someone else, you have some of the information in your pocket so that you know what to ask. Because one of the things that we flag all the time is the fact that people don't know the questions to ask and therefore don't know if their taxes have been filed incorrectly, if they haven't filed all the right documents. And we're going to work through some of those bits of information as we go through tonight. So to start, I'm going to share a very exciting document, which I need to change one setting because turns out something weird's going on with my Zoom, but this is fun. We're doing things live. Here we go. All right. So we do have a general advice disclaimer. So if you can see that. So the information in this presentation does not constitute financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation, or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. Uptrend Advisory and America Josh recommend that you obtain professional advice before making any decision in relation to your particular requirements or circumstances. Now, the reason we say that is because it's really important to know that some of the things that we talk about tonight won't necessarily relate to you. So while it's important and general information that will ultimately aid the questions that you ask, you do need to consult an individual professional. And we're going to talk about how you can engage Jason or another professional in the end of the webinar. So this year we've broken down the webinar into a few different sections. We've got the essentials that are all about like TurboTax and whether you have to file at all. Then we've got the regular tax filing questions that we get a lot. So mortgages and foreign assets and what to report and FBAR, which will come up a lot. You'll learn all about FBAR. And then we talk about some advanced tax filing questions for expats, things including life events, future planning, and investment strategies. So we're going to work from the top end of the funnel all the way down into the more specific end of the funnel. At any time, you can add to the Q&A. So you can type out your questions and I will have a look at those and we'll try and answer those as we go through. And at the very end, if we have some time, we'll also go through some of those questions. And I'm sure there's always, Jason and I will connect, in the coming days. And if there are any really good questions or any things that we really haven't gotten into, we will make sure that we get to answering those. And we're going to end with any mistakes or, the top 5 or top 10 mistakes that people make or the things that Jason sees when people are filing their taxes. So without further ado, I've talked enough about Jason Stoch from Uptrend Advisory. Jason does my taxes. Jason has worked with me on these webinars, as I said, for years now, helping people, helping the community and answering some of your fundamental questions. So Jason Stoch from Uptrend Advisory, thank you very much for joining me tonight. Do you want to say a little hello, tell us about yourself?
Gosh, thanks. Thanks for having me each year. I love doing this session with you as I know how helpful it is to Australians living in the US or about to move to the US. For those who don't know me, my name's Jason Stoch. I'm a chartered accountant in Australia and a CPA in the US, and I'm the managing director at Uptrend Advisory. At Uptrends, we specialize in helping Australians living in the US and Americans living in Australia navigate both countries' tax systems. So, this session is for everyone that is in the US or about to move to the US, and it's aimed to arm you with information because you don't know what you don't know. And so it's really important that you do know.
It is. I love it. There we go. You don't know what you don't know. That is the most fundamental part of this whole thing. So I thought before we get into the essentials of what people need to know about filing, Jason, do you want to explain, because I know some people might have watched some of the material from last year, so they're thinking, what's new? What do I need to know? What changes year on year for taxes? Like what should people expect that is different from last year if they're filing this year?
Yeah, so, for the most part, in most years, typically the standard deduction increases each year, year over year, and the tax brackets get adjusted for inflation for the year. So what that means in layman's terms is you move up into higher tax brackets at higher dollar sums relative to the prior year. Otherwise, There might be some little changes here and there with certain credits or energy credits or electric car credits over the years. But for the most part, those are the two core changes, unless, the tax code changes entirely.
Okay, so realistically, yeah, people, it's normal to expect, and we'll talk about some standard deductions and deductions and things a little bit further in, but to expect basically dollar values will slightly change, but the fundamental structure stays pretty consistent year on year. I know that the Trump presidency started yesterday, so it's a prudent time to talk about if we're expecting any changes because there has been a lot of talk of, upheaval and change. Do you what can people keep an eye out on? What should they be thinking about if they're watching the news and that might be relevant to them?
Yeah, so with Trump coming in, I know one of his agendas is to extend the current Tax Cuts and Jobs Act. And this is what he brought in 2017 because it's meant to expire at the end of this year. So ultimately, an extension of the current code would be a good thing for most taxpayers as it results in lower tax rates than in previous administrations where it was a different code. The standard deduction was much lower. So ultimately, it would be a good thing if it got extended. He does have a bunch of additional proposals, like eliminating tax on tips, no tax on social security income, no tax on overtime, additional credits and deductions. And a big one would be, removing the cap on the state and local income tax. But, it is important to note that these are proposals and proposals need to go through Congress to be ratified. So, until it's all signed off, it's not real.
Yeah. So no, it's important because a lot of people will see, and we talked about this on an America Josh webinar with an immigration attorney a couple of weeks ago. There's a lot of flash, but it comes down to what has actually been enacted. So don't worry yourself too much about what you hear might happen because it's important to consult your professional, talk to your professional, and make sure that you're listening to the things that have actually changed. All right. Now we've done some of the what's new and what might be coming. When it comes to the fundamentals, so I get a lot of people coming to me saying, like, I got a normal tax. I'm the simple tax, don't worry. And the problem with that is obviously that some people consider normal and easy to be like literally, they have one job and they live in one country. And other people say, like, all I've got is a couple of investment properties and the place I live in here, and I bought a new house and I've got two jobs and I earn some extra income on the side. What if it's your first time doing US taxes, what triggers it? When you've come to the US, what's the process to have to file taxes?
Yeah, so I mean, to your point, like it's so subjective about what a simple return is. Like to me, a simple return might be something completely different to what a simple return is to you. So it's hard
I'd hope
to,
so.
yeah, yeah. So, if it's your first time doing US taxes, just setting the rules of the road, the US tax year is a calendar year basis, so January through December. So, right now everyone's dealing with the 2024 calendar year returns, which are due April 15 each year. So, in terms of whether you need to file, it depends on did you have US income? What visa are you on? Are you a US tax resident? And all of that I know we're going to get into, but those are the first three things that you need to understand to know if you need to file. Because let's say you came on a J1 visa, you didn't have any US income, you're a non-resident for tax purposes, you don't need to file based on those three things. But if you're a green card holder and you lived in Australia, but you're a green card holder, you're a US tax resident, and you have to file. So it just really depends.
Okay. So it's not necessarily down to like minimum amounts of income. So even if you've like got a little bit, that's not necessarily even part of the equation, or it might sort of be part of the picture, but it is part of a narrative that goes to, there's going to be more questions about who you are and what you do. And as you said, visa status, types of visa, like how long you've been in the country. And we'll talk about residency in a bit because that's a specific one, but it's a bit of a matrix of things that lead to filing.
Yeah, yeah, absolutely. It's like a decision tree.
Yeah, I like it. So in terms of when it comes to, we hear a lot about the tax treaty. Pardon me. So the tax treaty gets thrown around as like, do I have to pay taxes because don't we have a tax treaty? Do you want to explain what is the tax treaty?
Yeah. So Australia and the US have a treaty which prevents double taxation between the two countries. So if you paid tax in Australia on your investments or any kind of income, this can be leveraged as a foreign tax credit on your US return to offset the tax that the IRS would otherwise want to calculate on it. And the same would apply if you paid tax in the US and were a resident in Australia. You would state your US income on your Australian return, as well as US tax paid on your Australian return to get the credits for offsetting what Australia wants to calculate. The biggest thing that I always tell new clients is that the treaty is with the ATO and IRS. So the US tax system has a federal system which is the IRS, and depending where you live, there might be state tax. So each state may or may not conform to that federal tax treaty. So, for example, I'm in California, Josh, you're in New York. Neither state recognizes the treaty. So that means if we had Australian income, each state is just going to say thank you very much and tax us on that kind of income.
Okay, so when you're filing in the US as opposed to Australia, one of the fundamental differences, just to expand on what you were saying, is that you not only file like with the ATO that most people will be familiar with, you're filing with a city, potentially with the state, and with the federal government. So the federal government has the offset. So they've agreed you won't pay that tax twice, but that potentially, as you said, in New York and California and other states, am I right in saying that that would potentially be full tilt? You'd pay just as much tax in New York, no matter how much you've paid in Australia. They're not looking at how much you've paid elsewhere. Is that right?
Yeah, that's correct.
Okay, so it really is like compartmentalizing that this is broken down into a few different boxes. So you might not be familiar when you first arrived that, yeah, this is one massively unique part of filing taxes is that you've got city, state, and local tax considerations. So then if we flip it just to talk about the Australian side, and I realize tonight is about the focusing on the US side, but just to quickly explain, who has to file, like, do you have to file in both Australia and the US, or who has to file in both places?
So this is one of those, it depends on your situation, but if you spend all of your time in the US, you might no longer need to file in Australia or at least file non-lodgements. If it's your first year in the US, but you spent most of your time that year in Australia, then you would still need to file in Australia. If you were not an Australian tax resident moving forward, the only time you need to file is if you still had Australian income, such as rental properties, or if you had student loans like HECS or help debt. But assuming you're a non-resident with no Aussie income, no student loans, then yeah, you don't need to file anymore.
Okay, so it really is about sort of like the activity. So there's the element of being resident. So, I've got one more question before I get to residency, but there's the residency element, and then there's the sort of financial activity. Is that the idea? So like if stuff's happening, if you're earning, or if there's HECS and help or rental incomes, that's the trigger that would potentially mean you have to file in Australia as well.
Yeah, yeah.
Okay, so when it comes to sort of the how to file part of things, what's the, like, first off, the calendar year, January, December is the US tax year, whereas July, June is the Australian tax year. So how does that overlap? How does that filing work when you're not filing in the same tax year?
Yeah, so given the two countries are on two different tax years, you can take one of two approaches. One is to file an extension in one of the countries that it aligns to the other country's tax return due date. That way, you're just dealing with tax in the US and Australia at one point in the year. The other way would be to prorate your Australian income from a financial year basis to a calendar year basis to declare it on your US return, and then determine what your effective Australian tax rate is on that income and claiming it as a foreign tax credit. And I know that sounds technical. It's a lot more simple when you actually physically see it being done, but those are the two methods. One, file an extension to make sure everything's lined up and everything can be done at the same time where the numbers are final, or two, prorate everything on a calendar year basis and determine your credit that way.
Okay, so yeah, that second one is basically saying like you're chopping the year into a segment and saying this is only a part of my year, and you're working out the math from that, from 50%, for example.
You're doing 100% on the US calendar year, but you're looking
at two parts of, okay, got it. Okay, so then we've talked a couple of times about this idea of residency. So there's some confusion, and I want to really emphasize this one at the very outset, is the fact that residency doesn't refer to permanent residency versus not permanent residency. It's nothing to do with that, but it's about like tax residency. So do you want to explain what tax residency means in the US? Like what is a resident? And this question literally came up twice today in the Facebook group. So non-resident versus resident tax resident.
Yeah, so this is the most important thing when it comes to filing your tax returns because it drives what needs to be disclosed. Either you're a non-resident or a resident. So, to be a resident for tax purposes, you need to either have an immigration intending visa, such as a green card or US citizenship, or to have passed something known as the substantial presence test. Now, the substantial presence test is based on the number of days that you have been physically present in the US in a calendar year. So if you've spent more than 183 days in the US, you will be a US tax resident due to passing this test. They do have look back rules where they can look at prior years and attribute days forward, but assuming you're under that threshold, then you would be a non-resident for US tax purposes. And at that stage, knowing which bucket you fall into drives the rest of the return, because when you're a non-resident, you only declare X. When you are a resident, you declare Y. So it just, depends.
Right. So, and this is where it comes down to, yeah. So visa status, again, is an important part of it because you touched on this before, but a green card, you are permanently resident, whether you are physically in the US or not. Like am I right in saying you're a tax resident as long as your green card is active as status? Status is active, brother?
Yeah, you could be in the US, you could be in Australia, you could be in Antarctica. If you have a green card, you're a US tax resident. Yeah.
Okay, cool. But then for the people that aren't on green cards, they can still be resident because they have been substantially present in the country. So even one of the questions that we get asked a lot is this idea that like, I've got income, but it gets paid from Australia into my Australian account. So like that's separate, that's not part of my package. But ultimately you're saying that doesn't matter. It's about like where you, like there's another equation about how tax residency works. Is that right?
Yeah. So where you earn the income can go into a different stream where you work out the source of where that income is. But in terms of tax residency, that is separate to where you're earning the income. And that is based on your visa status and, how much time you're spending in the US.
Okay. What about if you've worked remotely? What are the obligations if you're if you visited Australia and you're working for your US company? How does that impact things?
So it depends which entity you're employed by, like an Australian entity or a US payroll entity. If it's an Australian payroll entity, it's as if you're employed by an Australian company and file tax as normal in Australia. If it's US entity, well, it's US income and you need to file a tax return for that income. But it then comes back to that whole sourcing thing where, if you're living in the US working remotely for an Australian firm, technically it's sourced as US income because that's where you are living and working as an employee. And then you really need an expat accountant on the Australian side that is able to explain to the ATO that this is US sourced income.
It's not. Yeah. Okay.
Yeah.
Okay. So just to recap, because I know I've already had a couple of questions. So if you're an E3 visa is a good example of one where if you're on an E3 visa and you pass the substantial presence test, you become a tax resident. Is that right?
Yes. E3 visa, you're subject to the substantial presence test. E3, L1, H1B, all of those kinds of visas, substantial presence test. Green card, doesn't matter about the substantial presence test. You're always a US tax resident.
Got it. Okay. What about when do you stop? So there's probably some people on here that might be on an E3 and they're planning on leaving. When does residency end? Does it flip back the other way in the same kind of fashion?
Yeah, so, again, it comes back to your visa status. So let's say you went back to Australia and you were still on your green card, you're still a US tax resident. But if you left on the E3 visa, as an example, you would cease tax residency when you no longer pass that substantial presence test. If you're outbound and going back to Australia, there might be additional things that you might need to file with that outbound return to, kind of tie the bow on that kind of returns that you don't need to file in future.
Okay, so yeah, on that, so what do you need to notify the IRS or anyone about Like if you're saying I'm done, I'm finished with the US, is there any sort of, what do you need to flag? What do you need to do?
So you would definitely need to file that outbound return, and some situations require, statements like termination letter statements. Like this is all tax technical stuff, but there's a bunch of additional forms that you might need to file. One might be a termination letter. If you're giving up your green card, there might be an expatriation form. It just depends on your situation entirely. But once you've done that outbound return and you don't have any US income moving forward, that would be it, final, because you would have shown in your last submission that you were outbound.
Okay. Cool. Okay, so we've got residency, we've know how to file. One thing I didn't ask about filing and the sort of actual fundamentals is this idea of we hear a lot about TurboTax and we like about the idea of filing on your own. Do you want to explain like what is TurboTax, just so people understand, and what are these like what are people able to do? And then I'll ask you a follow-up about whether that's a good thing or not.
Yeah, so TurboTax is just a software that can file tax returns for you. You definitely can use it, but it is important to keep in mind that some of these softwares, don't even cater for non-residents. TurboTax only will do a US tax resident return. So if you're a non-resident, you can't use TurboTax, but you know, you can definitely self-file as long as you take the time to make sure that you self-educate and you know what your requirements are, you know what you need to complete and the specific forms that need to be completed. And why that part is so crucial is because, softwares like TurboTax, for example, TurboTax doesn't have an FBAR form within it. So we'll talk about what that is in a minute, but just as an example. So you'd have to go outside of that to file it to make sure you're compliant. Additionally, there are some other forms that it might not have because they're too complex and too niche for expats, in which case, if those forms apply, well, then you can't use that software. You need to go elsewhere. So as long as, you educate yourself, you know what you need to file, you know the forms you need to file. If TurboTax supports those forms, then yeah, definitely you can definitely file that way.
Got it. So it basically is about this idea that in theory, if you are aware of all the bits and you know that you've got, like, let's say I've got a foreign company and I know the form that I have to file if I have a foreign company and I know that it's the form blah, blah, blah. And in theory, you could go on and say, hey, TurboTax, I want to file that form and I want to file my own personal taxes and I want to file, and it would all be compliant. The problem is that it's not going to, am I understanding right? It's not going to ask you, hey, by the way, do you have a company overseas, or like, have you earned any rental income from overseas? It's not giving you the cues.
Yeah, it's literally a data entry module. It will do what
Got
you
it.
tell it to do. It doesn't have the smarts to tell you what you're meant to do because it's mainly catered for Americans with nothing overseas.
Got it. Okay. All right. When we're comparing Australia, because a lot of our viewers are going to be from Australia, when we're comparing Australia and the US, is there a tax-free threshold like we're familiar with in Australia?
So if you're a non-resident, no, you're taxed on the first dollar you make. But if you are a US tax resident, you get something called the standard deduction, which is a free offset. So that standard deduction for 2024 is $14,600 if you're single, and if you're married, it doubles. So assuming you earned under that, well then yeah, you don't have any tax to pay because you're below the standard deduction.
Okay, but so I think most people would be above that. So they have the option, and this is a good point to sort of explain the difference. So a standard deduction is different from what? So what are the two options when you're filing, or what are the options when you're filing?
So when you are filing as a US tax resident, you have the ability to claim that standard deduction as a default, or you can undertake a process called itemizing, where you claim deductions from a prescribed list. And ultimately, if that list total ends up being higher than a standard deduction, you go for it. It's an either or scenario. When you're a non-resident, you're not entitled to the standard deduction and have to itemize. And that's when, for better or for worse, it does result in a much simpler situation as a non-resident.
Okay, and I think I dare say, and would I be correct in saying that most of the people watching, because they'd be on E3s, like I think a lot of the audience would be on an E3 visa or some of the other similar visas, they'd be most people watching would be tax residents. Would that be accurate?
Yeah, the majority of our clients, I can say, are definitely US tax residents. There is a small percentage that are non-residents because they just got here at the end of the year or they've left earlier in the prior calendar year and they're under that threshold.
Okay, cool. It's a good one to know for the people watching because, yeah, I know residency is confusing, but make sure you look up the substantial presence test and that can give you a bit of a feel. But there's a high likelihood if you've been here for 6+ months on an E3 visa, you will be a tax resident. Jason, when it comes to tax withholding, so what how does it work with like what net income can I expect? Like what's getting taken out? What can I expect on my pay sheet that's coming off? And like, is there an average amount percentage wise that's being taken out for most people? Or like, how does it feel when you get here?
Yeah, it's definitely one of those situations where it can surprise you when you see what's taken out of your payslip because
There's like
people,
9 things on some of the, yeah, it's,
yeah, you've got federal tax, you've got Social Security, FICA tax, you've got state tax, city tax, and you've got disability and medical. It can add up very quickly. In terms of US payroll, depending on what allocation or election you've made with them, they will typically withhold, you know, based on your base salary and how that lands in a tax table based on if you're filing separately or jointly or single. It just depends. Other than that, the fixed percentages are, things like Social Security and FICA, where you're paying into the US Social Security system. They're going to take 7.65% of, your income. Certain visas are exempt from that kind of tax, like the J1s, but on an E3, you will need to pay Social Security and FICA. And so just know that it's a sunk cost. You can't get it back. You're paying into the system. And
yeah.
then, the other pieces are just, based on your elections and your income. There's some people who
So
would be.
that's things like dependents and stuff, the stuff that you tell your employer at the beginning of your employment.
Yeah, yeah. So for example, if, they're a married couple and it's a single income household, the spouse doesn't work, the primary worker would say we're married filing jointly and the spouse doesn't work and we've got these kids, and then payroll withholds less catering for that fact.
Right. And yeah, this idea that you are telling them what to estimate to withhold so that by the end of the year, what should happen is the amount you owe or are paid back is pretty close to what was estimated. And especially if you're filing a standard deduction, you'd get to the end of the year and it would kind of be a wash. And if you've had situations change or things, that's where there might be a cost involved with paying your taxes or receiving money back at the end of the year if you're off,
Yeah,
basically. All right.
yeah.
So when it comes to assets and property and declaring investments, so yeah, shares, stocks, real estate, investments, whatever it is, how do you go about reporting that on a US return? If it's from, sorry, Australian investments and stocks and real estate, how do you go about reporting that?
Yeah. So the first and simple thing is if you're a non-resident for US tax purposes, you don't. As a non-resident, you are only taxed on US sourced income. You do not declare anything from overseas countries, no foreign asset disclosures, no foreign income, no foreign structures, nothing. So non-residents have it easier. But when you are a tax resident, that is when you must disclose worldwide income, foreign assets, and potentially foreign structures like proprietary limiteds and trusts. So, you know, at a basic level, if you've got over 50,000 US dollars worth of foreign assets, foreign being non-American, whenever I say foreign, uh,
Yeah.
then then you need to complete a statement of foreign accounts in your US tax return. That form is called a Form 8938. If you're married, that threshold jumps up to $100,000. So that's the first form. You would also declare any income from those sources, such as dividends from shares, interest from bank accounts, indicating all of that on your return. As we talked about a few minutes ago, if you paid tax to the ATO on those same income streams, claim a credit for it with the foreign tax credit form. Outside of the tax return, we touched on it earlier, but there's that FBAR form that needs to be completed when your foreign assets are over $10,000. So those are the two main ones that I see most Australians trigger, the FBAR and the 8938. If you've got rentals, well, then you need to complete the rental schedule. If you know, got PFIX, there's PFIC forms, there's lots of different forms for different circumstances, but at a base level, whatever you've got in Australia, whatever income stream, interest, dividend, capital gain, rental, property, all of that kind of stuff, there are schedules where you need to declare it on your US return.
Okay. And I know I harp on a lot about this and I do it every year, but like this is why professionals are handy, because otherwise you have to remember not only the numbers of the forms, but the fact that because you did X, you have to file Y. That's the difficult part of all of this, is not so much like being compliant. It's again, not knowing what you don't know. So worth chatting to someone. One of the questions we had was around, from a tax perspective, are we allowed to buy property in the US as foreigners, as E3 holders, for example?
Yeah, yeah,
Yep.
you definitely can. Like, and there's definitely tax benefits to owning your primary home through that itemization process I just talked about, where you can actually deduct some mortgage interest and property taxes off against your income. Otherwise, from a investing standpoint, you definitely want to chat to a financial advisor, because there are tax benefits, but there's also a wider consideration based on what your actual investment strategy is.
Yeah, got it. And I think that applies also to, like, you'd want to speak to an immigration attorney and like make sure you've got ducks in a row, because as soon as you get into investing and sort of doing a lot of activity in the US, you want to make sure that your status is okay. You want to make sure that you've got all of those things in line, because it becomes part of a big tapestry. And I imagine, do you work with, like, you sort of are part of a matrix, and I imagine you connect and work with immigration attorneys and financial planners and things, that is part of a combo for when you've got your clients coming to you with questions?
Yeah, yeah. Like there's a small space, and there's not a lot of us out there, but we definitely work with financial planners. We definitely work with immigration attorneys. So, clients often come to us asking different questions, and we're able to point them in the right direction.
Okay. And does that, from the US tax perspective, can you invest, you can still invest in property in Australia as well, right? There's no issue, like there's big considerations as we just talked about with financial planning, but from a fundamental tax perspective, you are legally allowed to invest in foreign
Yeah,
Australian assets.
yeah.
Okay. You mentioned FBAR a few seconds ago. What is the FBAR? I'm going to start there. What's FBAR? Tell me, Jason.
So the FBAR is the most basic foreign asset disclosure form. You complete it when your foreign assets exceed 10,000 US dollars when you add them together. So bank account, shares, ETF, super, all of those kinds of things. If you meet that $10,000 threshold, you need to file it every year.
So sorry, just to make sure. So $10,000 in value across, it's not if you have one account, right? It's all of them pulled together into a pile. If you add them all together, if at any time throughout the year they get higher than $10,000, which, to be completely honest, it would be a lot of people watching, you need to file an FBAR. Is that right?
Yeah, yeah.
Okay.
So you could have a $10,000 bank account and a $1 CBA account and a dormant Westpac account. Because you've met the $10,000 threshold, all three accounts need to go on the FBAR.
Okay. Is the FBAR tax? Because I know some people, like, do I have to really tell them all about is it tax?
It's not. This is purely anti-money laundering. This doesn't go to the IRS. This goes to the arm of the government that deals with anti-money laundering, and that organization's called the FinCEN. So they're just focused on crime and enforcement, ensuring that you're not partaking in any criminal activity. There is no tax on these assets. It doesn't calculate anything. It's purely informational and purely a compliance activity.
So this is done in addition to, separately from filing your taxes. So you file your taxes and you're filing the 8938s and the all sorts of forms and things in the tax schedules that pop up. But then you also fill in a form that basically just discloses list by line by line, like here's all the money that I've got. And in that you file, am I right in saying you file the greatest amount that each account has been at any time?
Yes, so the form does ask for the highest balance in the account during the year if you know what the highest balance is.
Okay, so you, as an Australian, I would scroll back through two statements, because one statement probably shows my current status or my current, like if I go into CommBank, it tells me back until like the last end of the financial year. So I then have to go back into the statement, and then I download the statement and work out the greatest value from January through December. So for me, if I move money from one account to another, so let's say I have $10,000 to my name and I put it in my, Jason's laughing because the first time I did this, I really asked this like 25 times. I move it from my checking account to my savings account, and then I move it from CommBank to my Citibank account, and then I move it from my Citibank back to my third CommBank account. It's moved to 4 different accounts, but it's still only the same $10,000. I would still list $10,000 for each of those accounts if they all move. If
Yes, even though it sounds crazy and it's inflating the value of your accounts,
it makes me look good. There's a brief moment where I feel really wealthy.
like that is what the rules ask for in black and white. So, but again, you should take comfort in the fact that this is purely about compliance. Like there is no tax, you're not being taxed on your balance of your accounts. This is purely just informational disclosures.
Okay, cool. Speaking of forms, another one that pops up, the W8s, W8BENs, W9s. Can you explain, like, what are these forms? Are they tax filings, or like I think banks have been one that keeps sending the W8s to some people
Yeah.
here.
So these two forms are a simple yes or no ultimately. It's, are you a tax resident of the US? Yes or no. If you are a US tax resident, you give them the W8, the W9. That tells them that they don't need to withhold tax from whatever they're paying you because you're going to be filing a US tax return. If you're a non-resident, you give them the W8 Ben. That then tells them you're a non-resident and they must withhold some tax on their bank interest income or dividends so that the IRS gets some money in the event you choose not to file a US tax return. That's what the W8 versus W9 is.
Got it. Okay, so it's telling, it's a disclosure. It's like the FBAR, like you're just giving them some information and confirming with a signed document, this is my tax status, basically, to your bank. Or
Yeah.
to whomever is asking. So that who do you get these apart from banks? Who else might you get a W8 or W9 from? Just so people know what to look out for.
Banks, financial institutions, like where you have shares, possibly even if you're freelancing, they'll ask you, they'll give you one or the other so that they know if they need to withhold. Pretty much any US source of income outside of your W2 employment, they might give you that form.
Okay, cool. Okay, we've talked about some forms. We've talked about reporting. I wish I had like a little. I don't think I have emojis turned on, but the effect of superannuation. I feel like we could put a little marker here because superannuation is one question that we get asked about a lot, and I imagine it's one you spend a lot of time talking to people about, and you have lots of fun. There's a spectrum. Here's my understanding, and please correct me if I'm wrong. There's some different understandings of where superannuation sits on and how it should be reported. Is that correct to start? Is that correct?
Yeah, it is absolutely grey. There is no black and white answer, but most firms have kind of a decision tree matrix where again it's about the type of super, the contribution makeup, and things like that that drive, how it's treated and is it taxed in accumulation phase before being withdrawn. Yeah, in a nutshell, there's only one firm that took an interesting position, and that firm no longer exists. But
Okay. Okay. So yeah, I think this is just a really important one to emphasize. The reason it's grey is there is not a single like document that says superannuation from Australia is considered to be dealt with in the US like this. Is that correct? So that's why there's this sort of contention about what exactly it is.
yeah, like
Okay.
the treaty doesn't have superannuation in it. The treaty doesn't have 401k, IRA, Roth in it. And so that leads it to being treated, ambiguously by professionals and things like that. The only thing that's black and white is that the ATO at least have come outright and said, hey, we do tax 401k, we do tax Roth, we do tax IRA. The IRS hasn't said that about super.
Okay, so the other direction, there's definitely a consideration. When it comes to, so if you're adding to your superannuation, I know we've got a question here about PFIC and just in general about like utilizing your superannuation. Is it like, what's sort of your recommendation, or what do you tell people to do if they're adding to their superannuation, or how do they report it? Just want to recap on that.
Yeah, so the first thing is, what kind of super fund do you have? If it's just a regular industry super fund from when you're an employee in Australia, like yeah, you could contribute to it, but you do want to make sure that you are mindful of the composition of those contributions when you compare it against your employer's mandatory contributions. So in simple terms, let's say your superannuation's $100,000. How much of that was yours versus what your employer had to put in? If it's mainly made up of your own employer's contributions, then the treatment is just the disclosure on the applicable forms without tax in the accumulation phase. But if it's the other way around where you've put so much in that now that scale is tilted to you, well then yeah, you're going to have a negative treatment where you're going to be taxed annually on the growth or whatever's going in the fund. So it just really depends. But when it comes to contributions, that's something that you definitely want to be mindful of because of that whole element of control.
Okay. And do most super, like, do you normally, can you request the breakdown from your superannuation fund? Is that something you can request, or is that not always the case?
Not always the case, unfortunately, and it gets worse where, some super funds are bought out by other super funds, then you lose all that history. So it can be very difficult to determine that, and you might have to look back through years and years and years of pay slips to kind of build your own kind of composition breakdown. And if you're worried about that, then maybe wait until you go back to Australia so that it's out of the US tax system, assuming you cease US tax residency.
Yeah. Okay. And we had a question come in, which is a good one, just to recap and close the loop on superannuation. Do you report your superannuation on your FBAR?
So technically on the FBAR, they do say retirement accounts are exempt from reporting, but what does a retirement account mean?
Yeah.
So with all of our clients, we always report it on on the FBAR, because it's not a tax event, it's just a disclosure, and
Yeah.
it future proofs all of your FBARs against any kind of language change that makes it black and white, in which case, oh, we needed to do it all these years. Well, not a big deal. We've been doing it anyway.
Sure. Yeah. Okay. So still add it to your FBARs because it doesn't it's still just a disclosure document. It's not part of your taxes. But from a tax perspective, yeah, talk to your professional, build a bit of a profile. When it comes to, so do you want to just define the term W-2? I think people are going to hear W-2 a lot. So let's start there.
So putting it in Australian terms, it's the group certificate equivalent over here.
Okay. So it means you've got an employer. It's like a job. It's
Yeah.
the proof of a job. Okay. And that is opposed, and another alternative that people may have heard is 1099. Do you just want to explain the contrast between those two? Or are they contrastable?
Yeah. So a W-2 is what you get from your primary place of work in the US. They legally need to give it to you by January 31st each year. And what that contains is what your calendar year income was, what your elections were with things, like 401k, and then also what tax was withheld at the federal level and state level. And you get a copy of it, the IRS gets a copy of it, and the state gets a copy of it if you're in a taxing state. And that's one of the main artifacts that they use to reconcile against your return. So that is a W-2. A 1099 is a US tax document you might get if you had, bank interest income over $10. You'd get that from, Chase as an example. Or if you had interest dividends, capital gains from a US stock platform, you'd get a 1099 there. If you had unemployment income or other government support like maternity leave, you'd get a 1099 there. If you had freelance income, another 1099, or
Yep.
sold a US house, another 1099. But pretty much it's US income from sources other than your job.
Okay, W-2 is the job. So anyone on an E3 is going to receive before January 31st a document, probably in the mail, that is I'm seeing if I had one on my desk, but like a document that is sealed and it's got a nice little report, like a group certificate. But you're also keep an eye out in the mail for over the next couple of weeks, because you're probably going to receive one from your bank. You can download a lot of them now on online platforms, which is nice. But yeah, you're going to get a few of these documents, and your accountant is going to ask for all of them. So collect them, put them in a box, and then make sure that you've got them ready to go. What, from a tax, like minimization, optimization, like we talked about the standard deduction before, is there anything else, like if people are taking a standard deduction, is there anything else they can do to sort of minimize their taxes? Like are there things that expats as a group should be doing and thinking about?
Yeah, so as a W-2 employee, there's things that you can do at the W-2 level, and then there's other things outside of that in the tax return. So, at a W-2 level, there's only really two deductions you can do. One is your 401k, where you can defer money from the current year by putting it into your future retirement account.
Yep.
Obviously, that carries a whole wide range of implications.
So 401k is similar to superannuation, like conceptually, that's the
That
corollary.
is, yeah, that is the US kind of equivalent, but it is a little bit different. So, super, when you withdraw from it, typically it's tax-free. 401k, when you withdraw from it, it's never tax-free, it's tax deferred. So that's the one deduction. And then the other one is, something called a health savings account where you can, essentially use pre-tax dollars to pay for medical expenses. That's really it at the W-2 level. Outside of that, it's then what can you claim in your tax return to offset that income. So, if you have kids, you can get child tax credits, assuming they've got social security numbers or ITINs. If you own your home, you can itemize like what we were just talking about. If you've got, losses from selling shares, potentially some of that can offset your income. And then there's like the random itty bitty things like, daycare deductions or buying an electric car or installing solar panels. Like, it's very ad hoc-y in that sense, not really something that can be done year over year over year as a strategy.
Okay. Yep. So it really is about just answering the questions that you get sent and making sure you read comprehensively about what you're being asked. What about when it comes to, again, this minimization, just optimizing what you're doing? Is there a good time, if you have assets internationally, like if you have money that you want to move, is there a good time to do that? And is moving money taxable? Is that a taxable event?
No, because it's all post-tax dollars moving from one account to the other. It just again goes back to the whole you need to declare in those foreign asset forms that, hey, this CBA account had this much in it at this point in time.
And this
But
goes back to that's the exact point of the FBAR. It's like the money was in Australia, but now it's here. Now you can see where it went. But so is there a best time of year, like, or really it's down to the individual circumstance about like what you're.
yeah, it's really down to the individual. Like, I needed money to buy a house, so I transferred my money, or I'm gonna wait until the exchange rate gets better. Don't know how long you're waiting, but it just really depends, on your needs.
Okay. When it comes to, like, we obviously have a lot of people on E3s and a lot of people on visas, but some of them might have the option from an employer about going to a green card. And if you're staying in the US for a longer period of time, you might think that would make life easier. I don't have to go do the renewals. What are the implications of like having a green card? So we've talked about the idea that you'd have to file for every single, as long as you're on a green card, you'll have to file your tax return. But giving it up, what are the implications there?
Yeah, so when you give up your green card, the first thing is how long have you held the green card? Because the IRS does have something known as an exit tax, and you become subject to that exit tax test, not the tax straight away, but you become subject to the test whether you have an exit tax if you've held the green card for 8 calendar years. So 8 calendar years doesn't mean full 8 calendar years. It could mean like, let's say I got my green card December 31 last year. That's one day. The IRS said that's 1 year.
Right. Okay.
So super
That's
important to be mindful of that little nuance. But once you've held it for 8 years, if you give it up at that point, you are then subject to the exit tax tests, where if you satisfy any of the conditions, you need to pay an exit tax. If you don't, you don't. So with a lot of clients, we get a lot of clients who get green cards. We talk about it all the time, but you kind of want to plan to determine, are you guys staying or going? If you're going, well, what does everything look like? In which case, hey, maybe it makes sense to give it up now so that you're not falling prey of these kinds of rules. And I don't want to self-promote, but
yeah.
we do have blogs on this exact topic. Like, please, people, I write these blogs for you. So go read the 5-minute blogs because you don't know what you don't know. And we got lots of good nuggets there about topics like this.
Yeah, no, it is worth checking out uptrendadvisory.com, like, because you put out a newsletter, you write throughout the year, you do give some information away for free, just like you do come to the community each year. So thank you again. When it comes to like planning future, like obviously there are lots of questions that go into financial planning. From a tax perspective, when it comes to, should you be investing in a 401k or should you be looking at like Roths and IRAs and all of these kinds of things? Is that a tax question or is that really about sort of a bigger financial planning question?
So I'd say it's more of a financial planning at a holistic level where the financial planning should factor in tax as one bullet point as part
Sure.
of like strategy and considerations.
Yep.
We do have an article on this, but but for people watching, I touched on this earlier. 401k is a tax deferred vehicle where you're reducing your taxable income in the year that you're putting money into that fund. That fund grows over time, where if you then look to withdraw from it, you will pay tax at your marginal rates based on how much you have taken out from that fund. And so it becomes a tax planning exercise leading into financial planning where, let's say you're back in Australia or about to go back to Australia. Do I take out my money now? Do I wait till I'm retired in Australia? Do I take some from super, some from 401k based on what my needs are? It's that's kind of where it can become financial plannery as
Okay,
opposed.
got it. Yeah, right. So anybody that is living, even for a little while in the US and is from another country like Australia, it is worth engaging with a financial planner to probably talk about like how much should you be maximizing these investments in 401ks and how much should you be thinking about future planning? Because even if you don't have all the answers, there's a discussion to be had that can make sure that you're optimizing these things and not missing out on some pretty easy wins, I imagine. And on
Yeah.
that, from what about capital gains? How does that affect expats? Like, is that a unique thing for expats? Does it affect them uniquely or?
So no, I mean it doesn't apply uniquely because the US capital gains rules are the same for everyone. It's
Okay.
just that in the context of being a US tax resident, if you've sold stuff in Australia, well, you need to put it on that schedule and claim the credit for it. So, there's a lot of people that I've seen over the years who don't get advice beforehand, and they go to New York and they sell an investment property in Australia, they pay tax for the ATO and they don't realize, oh, New York wants some of this as well. So that would be the only uniqueness, is just making sure you're aware what you sell back home in Australia will impact over here.
Got it. And what about inheritance? I know that's one question that comes up when it comes to the inheritance taxes and yeah, that might be coming up for people throughout the year. What do people need to look out for?
Yeah, so generally speaking, if the deceased estate portfolio only consists of Aussie assets, there is no inheritance tax. If it does include US assets, then you might have to pay tax on it. Otherwise, if you're just receiving, inheritance from one of your parents who's not a US person, then there is an inheritance disclosure form that you need to complete. As I said, it's a disclosure form. There's no tax, but you need to complete it because all of these forms, if you don't complete these forms, there can be kind of crazy penalties.
That's a good segue there, Jason. So when it comes to like, what about if you haven't filed some of these things? So let's use the FBAR as an example because I'm sure there's at least one person watching right now that's going, like I've filed my own taxes and I've never filled in an FBAR. What happens? What happens if you haven't filed an FBAR, for example?
Yeah, I mean, it again depends because is it just the F bar? Because if it's just the F bar, well, then, you can go through a process to fix your F bars by amending them or submitting under a delinquent F bar procedure. But it really needs to be what is the scope of what was missing? Because
Okay.
what was not included but should have been included. So if you missed including some of your foreign assets or foreign income or foreign forms, you could be exposed to those crazy penalties. But there are, depending on the person and the case and whether it was intentional or not, there are amnesty programs that the IRS has that you can go through to get back into compliance, depending on your situation. If you decide not to do anything about it, if you get caught, then, obviously that
It's going
wouldn't
to
be
cost
good.
you.
And
It's
and
understatement of the century there, Jess. It's not going to be good. Yeah.
I mean, like just to give color as to like how bad the penalties can be, like, some of these forms have fines starting at $10,000 per year per form. So it is important to take it
Yeah.
seriously. And a lot of these procedures are first to act procedures. So, if you fall into the situation after digesting it and you want to kind of fix it, then, please reach out directly to me because we do help people through these kinds of situations.
Okay. So head in the sand, bad idea, because if the IRS finds out, or if the tax, whoever you didn't report to finds out themselves, that's basically when the fines really get hefty. Whereas if you come to them, just to explain, so there are amnesty programs, so you can basically say like, I stuffed up, here's my stuff up, and they can potentially be a little bit more forgiving. Is that right?
Yeah, yeah. Like with these amnesty programs, often they want you to include a statement explaining the good and the bad as to why you're going through it, so that the IRS can, determine whether they agree that you're fixing things in good faith or if you are willful or not. And then
Yeah.
assuming that, they accept you, then you're back up to speed, you're compliant, and you just need to make sure you're doing the right thing moving forward.
Okay. So when it comes to working with someone like yourself, I know I recently got one of your emails, I think, and it said you were running out of capacity for 2025 filings. Do you want to explain, like, how does that, because people may have heard this from their other tax professionals, or they may have seen emails that are coming up. What does that mean for a filing this year? Or what, and also what are the dates that people need to look out for in the next couple of months?
Yeah, yeah. So at a high level, W-2s come out end of January, and then if you have some 1099s from stock brokerages and things like that, it could come out now, but there are some that come out mid-February. In terms of the time to file, like again, April 15 is the deadline to file. You can get an extension in the US, which is an extension of time to file. But unlike an Australian tax extension, it's really important that you know that the IRS and state only see it as an extension of time to file. So if you owed anything by April 15, you're still expected to pay it. Otherwise, they're going to charge you interest until you actually end up paying. So,
Man.
so but not really. So, and how do you know what you're going to owe without actually doing the return? So that's like the big important thing. And an extension gives you until October to file. So it does give breathing room, but again, only if you've paid what you're meant to have paid. In terms of CPA firms and capacity and everything like that, like this is everyone's busiest time of year.
Yeah.
Like I know I'm going to go off this webinar and I'm going to have tons and tons of emails from clients and things like that because this is crunch time. This is our Super Bowl, for lack of better word.
Yeah. It's a cool Super Bowl.
Yeah, for some. But most of the good firms this time of year are very close to capacity. And what that means is we don't have space to help you anymore because there's only a certain number of clients that we can serve and only a certain number of team members. And that's kind of how it works. When a firm gets full, they will take on new clients, but they'd only take on clients with extensions in place because they know that they can't help you file by the deadline for multiple reasons. So
Yep.
if if you're looking for professional help, whether it's us or another firm, like this is the time to really, really grab one and lock one in because all of the good ones are going to be full, in the next few weeks.
Yeah, and it arcs back to what we were talking about before about the W-2s, and people are going to get them before January. They legally, am I right? They legally have to get them before January 31st. So a whole bunch of people are about to get a document that reminds them that their taxes are due soon, and they're going to go, oh crap, I need to reach out to and get my accountant sorted. So therefore, Jason and other firms will suddenly receive a whole flurry of emails in the next couple of weeks. So the reason we do this like we do it now because it's the most prudent time to learn about these things, but we do it early as we can in the year to make sure that you've got some time to actually engage and make sure you do the outreach now, because we don't want you to miss out. As Jason said, there's obviously considerations where you can extend, but you still have to know how much you're going to claim, and you won't know that until you've spoken to Jason, and Jason doesn't have time if he reaches full capacity. So make sure you do reach out. We're going to send a feedback form, and there is a way to get in touch with Jason at uptrendadvisory.com. Is that the best way, Jason, if they do want to chat to you? What's your process? What if somebody has questions? Is it that they sort of engage you professionally and then that's sort of the first step?
Yeah, I mean, in terms of our services, it's really twofold. One is the annual tax prep where we quote based on facts and circumstances. As everyone can kind of understand now, it's really kind of a decision tree matrix and Rubik's Cube to figure out your facts. But if you wanted to get a quote, you just need to go on our website, www.uptrendadvisory.com, complete the inquiry for US tax prep. You'll get an automated email allowing you to book in time to speak. I suggest booking in time sooner rather than later for obvious reasons. And then once you are a client and you have filed through our firm, then we do extend tax advice as an additional separate service offering. Unfortunately, due to bandwidth limitations, we can't just give ad hoc tax advice. So we just dedicate that time to our clients.
Yeah, I mean, that's what you hear now. You're doing that en masse so that you can answer the questions, but then ideally, yeah, so people need to engage, then they can ask the questions. So even if you don't have everything buttoned up yet, like you don't really know, but if you want to start the process, you can still get involved with you now, sign up and then ask the questions and then work through things together. That you don't have to have it all ready to go, right?
Yeah.
Okay. Final thing, do you have any like final tips or biggest mistakes or what's Jason's, like, people have been watching and learning, and I hope we've answered we've had a whole bunch of questions and we've done a pretty good job of working through a whole array of them. But what's your sort of, in closing, what do you have to remind people? Yeah, what have you seen?
Yeah, I mean, look, I've seen people not filing using the correct filing status, like people that are clearly married filing as single when they can't. I've seen missing information, like, or social security numbers missing a digit, or typing wrong. I've seen math errors, thinking that you can keep Australian stuff in Australia and US and that there's no integration, not taking advantage of credits that they need, filing the wrong tax return, like filing a non-resident when they were a resident or not filing at all. So again, it just comes back to education. Now, in terms of last minute advice, like what I'd suggest is, start looking out for your W-2s and 1099s. Make sure you're aware of your US residency and reporting obligations. If you're going to self-educate, then you can file yourself as long as you cover your bases. Otherwise, if you're not going to do that, then you should try to secure an expat accountant as soon as possible to ensure coverage and compliance. And again, like, read our blog. I write it for you guys. Just read it. There's a reason I write the articles I write.
Yeah, no, head to that, have a read. Yeah, as you said, like, make sure you collect all your documents, educate yourself. At the very least, my advice is, for your first tax filing, use a professional, because you don't know what you're doing. Like, unless you're a tax professional yourself, make sure you go ahead and get a professional advice for the first time. Then you'll understand what's involved and you can make an educated decision moving forward. Jason Stoch from Uptrend Advisory. We've got videos on americajosh.com/tax, which go into a whole bunch of these things. This webinar will be recorded and shared tomorrow so that you can watch all of the questions again. I want to thank you very much for joining us tonight and taking some of your time to answer a whole array of the questions. We will, if there are some questions that are coming through, I can see a whole array of questions popping up in the Q&A now, and we will make sure we try and answer those in our feedback post-webinar. But Jason, thank you so much for joining us, and thank you everyone for joining us this evening. We hope you've learned something. We hope we've answered some of your questions.
Thank you, Josh.